For years, I thought the only number that mattered for a growth ETF was its past return. Turns out, that's like picking a car based on the color of the paint. Today, we're putting two of the biggest names, SCHG and QQQM, head-to-head to see what actually matters. When I buy an ETF, I'm not just grabbing a random basket of stocks. I'm buying the engine that drives it. And that engine is the index it tracks. The index decides what stocks get in, how much weight they carry, and how the whole machine runs. I like to think of SCHG as my hybrid SUV, built for a smooth, steady ride across the entire U.S. growth market. QQQM? That's my turbocharged sports car with one mission: pure speed, powered mostly by tech. SCHG runs on the Dow Jones U.S. Large Cap Growth Index. The process starts by scanning the 750 largest U.S. companies, then narrowing it down to those with solid earnings growth. QQQM follows the NASDAQ 100, known for its focus on tech-heavy companies. Only the 100 largest firms on NASDAQ make the cut. No banks, no insurers. If you can't innovate or disrupt, you're out. This focus means I'm making big bets on technology. QQM can move fast in market changes, thrilling during bullish trends, and challenging when it cools off. SCHG strategy covers much of the growth landscape while keeping costs low. It's not an exclusive club, but an expansive net. They use earnings growth projections and profitability screens to filter out companies without solid financials, leaving about 229 holdings. Tech takes a big slice, but there's also exposure to financials, healthcare, and industrials. Visa is among the top 10 holdings. If SCHG were a camera, I'd call it my wide-angle lens. I'm buying the whole city skyline, ensuring balance across sectors. This approach means if one sector stumbles, another part of the portfolio steps up. It's steadier than most growth ETFs. Add in a fee so low, it almost looks like a typo. And it's a great fund for the long haul. Now, QQQM is a whole different beast. It tracks the NASDAQ 100, focusing on tech and innovators like Apple and Microsoft. QQQM holds just 101 stocks with a lot of weight in the top 10, making it feel concentrated and innovative. Think of QQQM as the matinee showing of a blockbuster. Same exposure at a slight discount. That discount is nice, but QQQM is still almost 4 times more expensive than SCHG. That extra cost pays for bigger, bolder bets on innovation. QQQM acts like a zoom lens, capturing explosive moves during favorable conditions, while amplifying every downturn when the market is shaky. SCHG charges just 0.04% a year. QQQM comes in at 0.15%. That's $15 for every $10,000. A gap that may seem small at first. But fees are like termites, small, quiet, and relentless. Ignore them, and they'll chew through more than you expect. On $100,000 with a 10% return, an extra 0.11% costs you $900 in 5 years to over $56,000 in 30. That's not pocket change anymore. You can't control market swings or inflation, but you can control what you pay in fees. Saving on fees means more money stays in your account. SCHG is built with cost efficiency in its DNA, making it ideal for long-term holders. Compared to QQQM, it's like paying for valet while free parking is just steps away. Owning SCHG and QQQM may seem like having two different portfolios, but they share over half their assets in just 10 companies: Microsoft, Apple, Nvidia, and more. Market cap weighting means bigger companies occupy a larger share of the ETF. It's like creating a music playlist where the same artists dominate. SCHG includes sectors like financials and healthcare, with names like Visa and Johnson & Johnson, while QQQM focuses on consumer tech, with companies like Costco and Netflix. SCHG feels like a balanced meal. I'm getting protein, carbs, and veggies in sensible portions. QQQM is like a box of energy bars, supercharged for quick bursts, great for speed. Both funds will keep me moving forward, but one is my full pantry, while the other is my quick energy choice. Historically, QQQ and QQQM have managed to edge out SCHG over the long haul, especially in a tech-heavy market. In 2022, both funds faced serious hits. SCHG dropped 36%, while QQQM slipped about 32.5%. In reality, these drops prompt us to face the uncomfortable truth of our investments. If you panic and sell during drops, the long-term charts lose meaning. You've locked in the damage. It's a hidden test with these funds. It's not just about picking the better track record. It's about if you can ride out the storms without jumping ship. Owning these funds means accepting volatility as part of the deal. The real question is, which ride can I handle? SCHG is the steadier, cheaper cruiser for comfort. QQQM is the faster, bumpier sports car, thrilling but jarring. If I had to choose one, it would be SCHG for its diversification and steady growth. But I own both. SCHG anchors my portfolio with low-cost U.S. growth exposure, while QQQM adds a technology focus. It's a bit like eating a well-balanced meal and then adding hot sauce, not because you need it to survive, but because it gives everything an extra kick. SCHG handles the heavy lifting, quietly compounding in the background. QQQM is the spice that amplifies returns when tech rallies. As tech stumbles, SCHG's diversification helps soften the blow. The mix is flexible based on your age and financial goals. In your 20s or 30s, you might tilt toward QQQM for more upside, while as years progress, shifting towards SCHG offers more stability. It's not about picking the perfect ETF. Control what you can, like costs and allocation, and let the market handle the rest. How do you balance growth and stability in your portfolio? Drop your approach in the comments to compare notes.